Hey folks, welcome to another video by Stocktrades. My name is Matt, and today we are going to be looking at two companies that we really haven't talked about too much on this channel. They are two reliable income stocks, and we're going to get to that right after this. One of the best places to find income and growing income on the TSX index is in the utility industry. If you dig a little bit deeper, regulated utilities in particular provide very stable income. Why? Because they have considerable moats and the dividend is underpinned by stable and regulated cash flows. One company that has a very big moat is Hydro One. It is among the largest utilities in North America and operates in a stable, regulated environment. One of the overlooked aspects of being a rate-regulated utility is that a company like Hydro One benefits from predictable growth. Why? It has expected rate-based growth under multi-year capital plans. This means that the company incorporates their capital plan within their submission for re-rating, and they can predict their organic growth profile better than most. Hydro One expects rate-based growth of 5% and organic earnings per share growth of approximately 4 to 7% annually through 2022, earnings which are 99% underpinned by regulated rates. Since the company went public in 2015, Hydro One has returned approximately 70% to shareholders. This includes the dividend. In comparison, the S&P TSX index has returned around 50% over the same period. In our current environment of uncertainty, Hydro One has provided stability to portfolios. Over the past year, Hydro One's stock price is up by approximately 13%, which once again far outpaces the index, which has been flat. When you couple Hydro One's reliable organic growth with an appetite for making acquisitions, Hydro One is well positioned to deliver outperformance year over year. Perhaps the most attractive aspect of Hydro One is not only consistent and reliable earnings growth, but the company is also a Canadian dividend aristocrat. Hydro One's growth will enable the company to support the dividend. As the company only went public in 2015, it may not meet investors' criteria for dividend growth. You see, many investors rely on Canadian dividend aristocrats or all-star lists as a starting point for their research. Aristocrats and all-stars are companies which have dividend growth streaks of at least 5 consecutive years. This reliable history of dividend growth is attractive to income investors. So the good news is that Hydro One can now count itself as one of those prestigious group of dividend growth companies. Last year, the company raised the dividend by 5%, and the raise effectively extended the company's dividend growth streak to 5 years. Over this period, Hydro One has averaged 5% dividend growth. So now that the company has officially achieved aristocrat status, it will be added to the funds that track the Canadian Dividend Aristocrat Index, such as the iShares S&P TSX Canadian Dividend Aristocrat Index. Although a historical dividend growth streak is a good thing, it's also important to look forward. Hydro One's dividend accounts for only 63% of earnings and 28% of operational cash flows. Although the company's payout ratio against free cash flow looks high at 130%, it's important to note that it operates in a high capex industry. It is consistently renewing and building new infrastructure that requires significant cash outlays. Now, this is normal for utilities, and the safety of that dividend is best compared against earnings. Also worth noting, Hydro One's current payout ratio is below its targeted range of 70 to 80%. So what does this all mean? It means that the company is well positioned to continue raising that dividend for years to come. Hydro One isn't a flashy stock, but what it can provide investors is reliable income and growth. It can do so both in terms of dividend growth and capital appreciation. Likewise, as we've seen over the past year, it can also stabilize one's portfolio in times of uncertainty. So Hydro One is definitely one that investors should consider, especially now that it has achieved aristocrat status. This is one of the knocks on the company. As a newly listed company, it didn't cross investors' screens in terms of income. Now that it has achieved aristocrat status and all-star status, the company should now meet several investors' screening criteria. Another utility that investors might want to consider is Emera. Before we jump into Emera, let us know in the comments, do you own Hydro One? Personally, I don't, but that's okay. It's not that it's a bad company. I just have pretty significant exposure to a company like Fortis, so adding Hydro One to my portfolio is not necessary. But I'd be curious to hear your thoughts on the company, so please let us know in the comments below. Speaking of Canadian dividend aristocrats and those like Fortis, which have a very long dividend growth streak, another company that doesn't really get quite as much attention as it should is Emera. There are 11 Canadian dividend all-stars in the utility industry, and Emera is one of the biggest, with a market cap that is almost double the size of a company like Canadian Utilities, which owns the longest dividend growth streak in the country. Not only is it one of the largest, but Emera has been a very consistent performer. Over the past 3, 5, 10, and even 20-year periods, the company has outperformed the TSX Utilities Index. So that level of outperformance is very impressive. And how did it fare during this past year of turbulence? Well, surprisingly, it's actually underperformed, as the company's share price disconnected from the index in July of this past year, and it has since struggled to keep up with the index. So while investors might view this to be concerning, there is a reason for this disconnect. You see, the utilities index contains several renewable energy companies, and this past year, their stocks have been white hot. On the flip side, if you take a look at traditional regulated utilities, you'll notice that they are all underperforming the index. The only one that is outperforming is Hydro One, and we've already talked about that. It's returned 13% over the past year. The second best? That's Emera. It has been the second best performing among the traditional utility peers, and it is yet another sign of its status as one of the most reliable. That's right, it is outperforming peers such as Fortis and Canadian Utilities. We talked about aristocrats and Emera being among them. Emera's 14-year dividend growth streak is among the best. It is in the top third of the country, and it has averaged 6% annual dividend growth over this period of time. While the pace of dividend growth has slowed, it is still a lock to deliver mid-single-digit dividend growth year over year. Now you might be asking yourself, how can you be certain of this? Well, for starters, Emera's dividend is well covered. Although it accounts for a high percentage of earnings, on a forward basis, the payout ratio drops to 72%. Furthermore, the dividend accounts for only 43% of operational cash flows. Investors might be looking at the high payout ratio as compared to free cash flow and seeing 780% and be pretty freaked out about that. But remember, as high capex companies, comparing the dividend against free cash flow in the utility industry is not ideal. But in case you've had any further doubt, it is also worth noting that Emera has issued dividend growth guidance of 4 to 5% through 2022. Emera has consistently delivered and met dividend growth guidance year over year. Transparency on future dividend growth is a luxury and much appreciated by dividend growth investors. Not only that, but Emera has a clear path to growing the business. It plans to ramp up growth through a $7.5 billion capital program. The program is expected to generate an 8.2% compound annual growth rate in rate-based growth over the next few years. The company aims to fund said growth through a mix of cash flows, debt, and equity. This balanced approach to capital projects will enable the company to further strengthen its balance sheet. In recent years, the company has been focused on reducing its debt and is targeting a debt-to-equity ratio of about 55%. This is down from 65% in 2016. So overall, Emera is what we would call a pillar of consistency. It has delivered strong performance. Sure, it might not have the growth rate as some of the renewable companies, but in terms of reliable and stable cash flows, Emera is definitely among the best on the TSX index. While it may not be the high growth stock it once was, mid-single digit dividend growth coupled with mid to high single digit capital appreciation, and you're looking at a very solid stock for your portfolio. Once again, I don't own Emera, but I'd be very curious to hear your thoughts, especially in compared to traditional regulated utilities like Fortis and Canadian Utilities. Do you think it's a better buy than either of those two? Let us know in the comments. As always, please like the video and subscribe to our channel. You don't want to miss out on any more great Canadian content. Until next time.